ma'am, to escort our distinguished faculty, Shri Ketan Dalal sir, Saurabh Soparkar sir, and Kaushik Patel sir on the dais. Please let us welcome with round of applause. Now we are starting the post-lunch session, panel discussion with the distinguished guest. First of all, I would like to introduce our one of the guests, Shri Ketan Dalal, who has 40 years of experience in tax issues and investment restructuring. He was managing partner at PwC from 2017. He started his own firm, Catalyst Advisor Private Limited, and his clients are TVS Group, JM Financial, Datamaticals Global Services, and he is also on the various committees of SEBI, including SEBI's High-Powered Advisory Committee. He is also director to HDFC Life Insurance, Zensar Technologies, Torrent Power, and many others. So I request, with this brief introduction, I request our chairperson ma'am to welcome our guest with the memento. Please put your hands together in welcoming the guest. Other guest, none of the person is require introduction on this dais, but it is a matter of pride for us to introduce Saurabh Soparkar sir. A person when start a CA journey, when he learn the T for tax, he must know the S for Saurabh Soparkar sir. So that kind of introduction I can give in a nutshell. He is a senior advocate and he is a regular speaker in providing services to fraternity. I request chairperson ma'am to felicitate with memento. Please put your hands together in welcoming our dear Saurabh Soparkar sir. Our branch past chairman who had our branch in 1980-90, who was also the president of CA Association of Ahmedabad. He is also a speaker at various forums. He is also contributing to our profession since long. He was co-opted member of Auditing Standard Board of ICAI. With this brief introduction, Kaushik sir, I am welcoming you. I request chairperson ma'am to give memento to one of the renowned faculty, CA Kaushik Patel sir, partnering, managing Manubhai Shah LLP. Now I request chairperson ma'am to start the session.
Thank you, Abhinav. Originally, the idea for this session was a presentation, and then with our esteemed faculties, it converted into a very, very beautifully drafted panel discussion. So we had been talking about the growth story of Astral. We got important points, how the M&A process runs, the due diligence process. So now the most important part of M&A, transaction structuring. So for that, I would request CA Ketan Dalalji to explain us the process of transaction structuring. Then I have certain questions, and post that we'll have also questions for the audience to ask. So I will request, yeah.
So first of all, good afternoon. Thank you, Anjali Choksi, for introducing this session, and thank you, Pinkesh, for the introduction. So originally the idea was to have a sort of 15-slider PPT, but partly because of time and partly because the format changed, I'm just taking you through a couple of slides, and then we'll have the panel discussion as Saurabh Bhai, Kaushik Bhai and I were discussing. So how does it go? This way. So while the technology always fails us at the right stroke, wrong times, so while he's doing that, one of the things that is become very, very important is that in the last 10 to 15 years, particularly, transactions have become, the norm. So for a variety of reasons. So for example, you have a large company, and I'm talking now of internal and external transactions both. internal transaction would be like, let's say, a group merger, a group demerger, a buyback, because quote unquote, it is also somewhat like a transaction. Sorry? Okay. So, it would also be a transaction. And then, of course, there are external transactions. For a variety of reasons, the number of transactions has gone up. So, take an example. You have two businesses, let's say pharma and agri, in the same company. And I have such a situation, and I have been trying to persuade the management that the investors who want to invest in pharma may not want to invest in agri, because the risks and rewards of the two businesses are completely different. So this is a classic case of XYZ reason why there may need to be a demerger. You may have two companies in pharma, for example, in the same sector. So you may have to merge to create a much more robust entity, because if you want, for example, an IPO, or if you want a private equity, they do not like what I call fracturing of value. So there are a whole host of reasons. In the second slide, which will be the last slide, actually will take you through this. But let me first tell you this. You know, what is happening is, and I think maybe Sanjay Bhai in the previous session, or maybe Drishti was mentioning, you cannot have a siloed approach. So whenever you are thinking of an M&A transaction, whether internal or external, I, in my mind, look at what I call, and it's sort of my own creation in that sense in my head, the CRT waterfall. C, commercial, R, regulatory, 3, T, tax. Actually, tax can be tax and fiscal, so it could actually be CRF, because you will also have stamp duty, for example. That's a fiscal cost. And you cannot do a transaction till you have, or you cannot be logically advising on a transaction, whether as a part of an industry insider or as an advisor, till you have that integrated view. So commercial, to my mind, will always take precedence. Because if you do not want, if the buyer and the seller want to do a transaction in a particular manner, and the flexibility of that, whether in value or in the nature of the transaction, is sort of pre-agreed, then the advisor has no choice. And a classic example is, if I am a buyer, advising a buyer, I generally prefer a business purchase. Why? Because my ability to ring fence liability is there. But the seller may not want that, because then the money winds up in the company and he cannot extract the money out of the company because of dividend reason, blah, blah, blah. And if my client is desperate to buy that business and does not have much negotiating power in the nature of in the manner the transaction is structured, then obviously I have to go for a share purchase. I cannot say I'll get more depreciation, I'll ring fence liability, the seller will go to hell. But I don't want to do it this way. So commercial. Regulatory, and this is becoming, I think, Drishti and Sanjay Bhai and Chinmay, I think that session, the last part which I attended was very, very helpful. You know, whether it is SEBI regulations, you know, the amount of scrutiny that all this is going through in listed companies, of course, is one. You have FEMA regulations in anything to do with a cross-border transaction, whether it is a non-resident buyer or a non-resident seller. You have company law regulations, and we will talk about it during the panel discussion, whether it is NCLT, whether it is related party transaction, whether it is a need for special resolution, majority or minority voting, all sorts of things. Sector-specific laws, so let's say RERA, you know, for NBFC, RBI regulations, you know, for an insurance transaction, you have IRDA regulations. You cannot run away from sector-specific. Of course, in some cases, there are no sector-specific regulations. If you're buying a chemical company, I mean, there'll be environment protection, etc., etc. It may not be very directly relevant to the transaction. Okay? Ind AS. Now, accounting is becoming a very, very significant aspect. So, in a merger or a demerger, the application of Ind AS 103, etc. And in income and in tax, of course, you have income tax, you have GST, you have fiscal. So, I will discuss all this during the course of the panel discussion, so I won't go into that. So in this introduction, this is the last slide. So if you see this, I've divided between internal and external, and in internal, the objective could be facilitating divestment. So for example, as I mentioned, You demerge the company because you may want a joint venture in one part of the business, say pharma. Because a guy who wants to invest, an investor who wants to invest in pharma is not going to be able to invest, and you do not want him to invest in a company which is, let's say, agri and pharma. So that could be one. We are doing, for example, currently one where we have company with a lot of cash, money sitting in the company, lot of treasury, and the potential JV partner is saying, look, I don't want to invest in this company, but I don't need the cash. So we are doing a drop down, and he invests in the drop down. Now, that may have certain other negatives, but the commercial imperative of the deal is driving that structure. Okay? Facilitating family settlement, group simplification. You have all sorts of, let's say you have a company where on top, for example, so at the shareholding level, you have 3 holding companies. Now, I was talking to a promoter and I said, why do you have these 3? He said, honestly, I don't remember. I do not remember. It's 30, 40 years ago. So you have all sorts of structures which today may just, even for the sake of simplification, you may need to clean up. It's a cleanup. It's like cleaning your cupboard of old shirts which you're never going to wear. Okay? Facilitating family settlement. This is a very, very big topic. I'd rather not discuss it now. When something in the family, or something in the panel discussion, Anjali will come up, I'm sure, on that. Segregating businesses, matching risk reward. This is a very interesting one. We are looking at a situation, we are examining, and it'll kickstart shortly, where we are thinking of demerging NBFC from fund-based and non-fund-based. Because fund-based business has a far higher risk than non-fund-based. So we are looking at that segregation based on the risk-reward profile. Balance sheet right-sizing, capital reduction, this, that, etc. I won't go into details. External M&A, value unlocking, you are divesting, you are giving part, you are sharing part of the risk with somebody. You may be wanting to tie up with somebody who may invest 25% because he has got firepower, either strategic or financial. You may want to buy a business because a consolidation will give you far greater firepower. In the prior session, we were talking about IBC, so you may go in for a distressed acquisition, fundraising for a division, etc., etc. So I think with this background, I didn't want to sort of carry on, but I thought that this will give a framework which will facilitate the panel discussion. So with that, thank you, and then we can get into the panel discussion.
I have, apart from what Ketan has said, one more angle which probably is also required to be focused. Traditionally, we have always thought about mergers and demergers, and at times buyout of the assets of another entity as and by way of or under the category of mergers and acquisitions, or as and by way of either splitting an existing business or acquiring a new business. Whereas in relation to splitting of an existing entity, obviously demerger would be the way out. Now there is entirely a different ball game, and this is where I would want more and more chartered accountants to be involved in the matter of acquisition by virtue of the introduction of insolvency and bankruptcy code. Prior to IBC being introduced, when a company would start facing financial problem, a creditor would take it to liquidation, winding up in the High Court. The matter would be dragged on for years together until the company is taken into liquidation. The management which is guilty of bringing the company to the financially difficult position continues to run the company. In other words, till the order of liquidation, or in a rare case, order of provisional liquidator was passed, the erstwhile management continued to enjoy the show. In between, the position was worse because of the provision of Sikh Industries Company Special Provision Act, SICA, where the moment a reference was made to BIFR, the promoters would be immunized from any possible action, and therefore people would suddenly become sick overnight, make a reference to BIFR, and therefore get an immunity, and then for one or another reason, case would not proceed with the BIFR for years together. Government having realized that this is not in the interest of industry, economy, world of business, this IBC is introduced. Now the beauty of IBC is, one, it seeks to bring about a quick solution to the problem, and two, more importantly, pending the restructuring of the company, the debtors, the management of the debtors or the company who brought the company to this position are replaced by an independent resolution professional. It is whose job to ensure that restructuring takes place. Therefore, what was not possible under the old regime of the Companies Act of restructuring a company, if a company is sick, either you wind up, or it is not sick, you continue. Now the focus is, whenever a company runs into financial difficulty, attempt must be first made to restructure. That restructuring is to be done with the help of an expert, a resolution professional. A chartered accountant is most suited to be a resolution professional. And resolution professional will, with the consultation of committee of creditors, try to evolve a mechanism whereby the company can be again put back on a strong footing. Two very important things here. One, IBC overrides every other law, barring couple of exceptions. Section 238 of IBC says it overrides, which would mean that whatever was legally otherwise not permissible under the general law, and whatever was therefore not legally feasible under the old methodology, you can now start thinking out of box. For example, if a company is being restructured, who would have the biggest objection? Old management, because old management is being thrown out. Under IBC, you can have a resolution plan whereby you can say the share capital of the existing share capital of the company will be cancelled. And the promoter who is now taking over the company, successful resolution applicant, he would be allotted full shares. Now, as chartered accountants, all of us know, but if this happens, there's a change in the shareholding pattern, section 79 of the Companies Act will come in, carry forward losses will not be allowed, Income Tax Act is amended. And now, therefore, if a resolution plan is sanctioned by the NCLT, after notice to the Principal Commissioner of Income Tax, even carry forward losses will be allowed. I'm giving only one example to show that now the focus is on restructuring of the companies wherever it is possible. Now there are bound to be some deadwood cases. It's impossible to revive those companies. You can revive them, please do that. If you can't revive, wind up, liquidate, and immediately get the money distributed. Therefore, one area of practice where we really need to find out is how to restructure a financially weak company. Take a classic case of, which was being shown as the major case under IBC, SR Steel, one of the biggest steel manufacturers of the country. It became financially weak and ArcelorMittal took it over. I'm sure, but for IBC, it would not have been possible because Ruyas would have never sold shares to a third party. And banks would never have been able to take control under the Securitization Act, sell it, it would have taken ages. So, whereas these mergers, demergers, they are all important. Now, one more angle and one more area which we need to concentrate is how best to bring about solutions in relation to sick company under IBC. And we may also look into the aspect from the perspective of commercial rationale. Once you are able to justify commercial rationale, then probably no law will come in your way because every law gets overridden. There are some tricky issues over here, but to begin with, this is one area where I thought I must share with you my thoughts because this is something which is both interesting and also challenging. And it is here where the chartered accountants can play a major role, both as persons to evolve the resolution plans, to draft resolution plans, to work as the resolution professionals, and probably to also work out in the event a resolution professional is unable to bring about a resolution, to work as a professional liquidator, because now even professional liquidators are being paid not the salary of what official liquidator would get, they would be paid as a percentage of the assets of the company which are sold, and the remuneration runs into more than a couple of crore of rupees in a given case. So this is again one more area of restructuring, and if restructuring is not possible, how best to get rid of the company and convert into cash. This is to begin with my view.
Thank you, sir, for bringing the new aspect, structuring, restructuring, and I would now request Kaushik sir to share his thoughts.
In fact, when two experts and stalwarts are here, I think I am a very small person to say anything about the subject. And I would also admit my limitation that my perception of the subject is as an auditor and not as a consultant. So how far I will be able to justify my role is a question. In fact, I was wondering why Anjali selected me as a panelist for this session. But I accepted because I am among the midst of the experts. So I thought that my role will be very limited. Be that as may be. So far as transaction structure is concerned, I think traditional way the transactions are structured is the merger, amalgamation, demerger, slump sale, share purchase, and in case of non-corporate entities, it is by way of corporatization, that is conversion of LLP into company or otherwise way. So all these modes of structuring have their own merits and demerits, and as Ketan has rightly said, that various aspects will have to be considered in that context. I have been asked to deal with the subject in the context of company law and accounting aspect. So far as company law is concerned, the chapter 15 of the Companies Act 2013 contains the provisions relating to merger, and it is spread over 11 sections, section 230 to 240 of the Companies Act. And section 230 deals with the overall scheme of reconstruction or arrangement, and 232 specifically deals with the provisions relating to merger. As we know, the powers of approving the scheme of mergers have been given to NCLT. The scheme is required to be prepared, put up before the NCLT, consent of the creditors, shareholders, etc. required to be obtained. Most challenging would be in case of a listed entity where this SEBI's approval would be required. So that takes a time. Merger route, I think, is now taking a long time considering the pendency of the cases before the NCLT, and in some cases it takes more than 1 year. But that is one of the way of structuring the transaction. When it is within the group, you may consider other way, but outside the group, if there no other way is possible, and if you want to bring the synergy into operations, on consideration of tax laws, merger can be considered as a proper route. Other type of transaction is demerger vis-a-vis slump sale. Question would remain, which route should be adopted? And there the consideration will be with reference to both the purchaser, acquirer and acquiring. Both the will have to consider that aspect. Slump sale is considered to be an easier route and faster route in the sense that it doesn't require the approval of any regulatory authority. Whereas in case of demerger, the same route of obtaining the approval of NCLT is to be followed. So that may take a longer time. But the disadvantage in that the slump sale, as Ketan Bhai said, that money comes into the company's account. So question would be how to take out the money which comes in the hands of the company, and which may involve the tax implication that it is taken away by way of buyback, then it will require the payment of tax by the company at the rate of 23% buyback tax, or if it's taken by way of dividend, then it will attract the tax in the hands of the shareholder. If they are in the higher bracket, more tax outflow will come. So we'll have to weigh the consideration of demerger versus slump sale. The benefit of demerger is that the shareholders of the selling company or the demerged company gets the shares of the other company. So that's beneficial, but it takes a longer time. So this is what about this. Coming to the accounting aspect of the structuring of the scheme. So far as slump sale is concerned, as such, there is no specific accounting standard dealing with it. It will be simply a sale and purchase of the transaction. Only question would be from the buyer's perspective is to take out the valuation of the assets and liabilities taken over and allocate the value in the case, in its own entity who has acquired this, and there the question of putting the value to the intangible assets or the goodwill may come, and there the tax implications will have to be considered. So far as merger is concerned, the companies we follow, which fall under Indian GAAP, we have AS14, which deals with the provisions relating to accounting of merger, and the entities which are listed entity or which fall under the Ind AS regime, the Ind AS 103 business combination is applicable, and there are so many issues to be considered. Other questions which are going to follow there, these aspects are going to be dealt with in greater detail, so I'm not going to deal with them. So far as share purchase is concerned, that is transfer of promoter shareholding, like recent cases of acquisition of Sanghi Cement by Ambuja Cement Limited. So it was merely a change of shareholding by the promoter group within the same group. So in that case, I think there are not much significant accounting aspect is involved so far as the company whose shares change hand. So that seems to be from the accounting aspect. Thank you.
Thank you, sir, for throwing light on the accounting and corporate law perspective. Now, going away with the specific questions, beginning with the approach to transaction structuring. How do we decide the approach to transaction structuring, and what are the important points to be kept in mind while deciding the method? And going further, when there are conflicts, how to resolve the conflict in terms of selecting the method? So beginning with Ketan, sir.
So, as I mentioned in the initial part of the presentation, the heart of the issue is commercial imperative. This is the heart of the issue. For example, suppose two companies have decided to combine the business, okay, Inox PVR, classic example, where I think you are one of the values, if I remember rightly. So, where they have decided to merge the business, and obviously they are not going to pay one another, because anyway they are coming together, it has to be a merger. When a business is to be split and put into another company, and they are not willing to pay for it but getting shares, it has to be a demerger. As I said, when a buyer is wanting that I want this business, but I want only by way of purchase of shares, or sorry, seller is saying I only want to sell by way of sale of shares, then you may not have a choice. However, to your question, where there is a quote unquote conflict, as you use the word, and I would put it as choice of methods, and both parties are a little flexible, then it depends upon which will create a win-win, because I have always believed that the transaction should create a win-win. But if for some reason the transaction is not creating a win-win, then as it happens in the case of the law of the jungle, the stronger the lion will eat up the fox, right? So that's the way it will work. But I think from a tax and fiscal perspective, take an example of an internal structuring where two group companies or semi-group companies are merging. Even you take a huge, enormous merger like HDFC Bank, classic example, which merges into which could have been driven by a large number of issues. One of the issues, of course, was that HDFC is a bank. And for a bank to merge into a non-bank would be, I suppose, a regulatory nightmare. So, I mean, was there a choice available? It could have been. But HDFC Bank, as I think about 3 lakh employees, HDFC had 5,000 employees. HDFC is a bank, bank is a bank, and HDFC is obviously not a bank, and so on and so forth. Third issue could be, I remember many years back in 2 steel companies where I was an advisor, core advisor to the merger, group companies, but listed. So in that sense, there are different economic interests, so the swap ratio, obviously becomes very critical. But the swap ratio could have been adjusted both ways to see that it is fair to the shareholders. So that could have been done either way, because we wanted to do some capital reduction, but ultimate effect was obviously intended to be fair to both groups of shareholders. But the choice was which merges into which. And there were tax issues, loss carry forward issues, but there was also stamp duty issues. So one was in Karnataka, one was in Mumbai. The Karnataka entity at that time, I'm talking of 15 years back, the value of the assets would have been 4,000 crores. The Mumbai entity would have 500 crores. So from a stamp duty perspective, it made no sense to merge Karnataka into Bombay. So we merged the smaller into the bigger. Also the bigger had losses, so that section 72A issue did not come up. But we had to do a capital reduction of the Karnataka entity to make sense and to have a quote unquote right-sized balance sheet. So it was an integrated issue. So this, I mean, there are obviously many examples like this. But when you have two possible methods, you will choose the method which in an integrated fashion makes the most sense.
Saurabh sir.
There are transactions which can be entered into by the parties without resorting to an independent agency's approval. That agency could be SEBI, stock exchange, or even NCLT or a court. Now, whenever a transaction can be entered into between the parties on their own, surely there is more flexibility, because you can always give and take, and you are not really worried about someone else looking over your shoulder to examine validity and appropriateness of the terms of the transaction. But the moment transaction needs to be approved by, for example, merger or demerger, NCLT, if it's a listed company before NCLT, then you also need approval of stock exchanges, which in turn will go back to SEBI and get their approval. You may also need approval of sectoral regulator if you are part of a sector which has a regulator. Then you need to be extra cautious in picking up the terms, because it is likely that what is commercially acceptable to the parties may not be acceptable to the regulators or overseers if they come to a conclusion that what is agreed to between the parties is likely to prejudice interest of the shareholders or is against the interest of market or for whatever reason. But even where you have a choice, or even if you are otherwise acting in accordance with the permissible field, there are areas where quote unquote creative scheme can lead to a great advantage. Let me go back to what I started with, IBC. Take a case of a company which is before IBC, there are assets worth rupees 500 crore which are not likely to be realized, it's a loss. But there are liabilities worth rupees 500 crore. Now the beauty of IBC, for example, is that for the purpose of getting the scheme approved, you only need to consult the financial creditors who have given money. And all others who have supplied goods or services are not even required to be consulted. Even without consulting them, you can provide that not a rupee would be paid to them, or against 100 crore, only rupees 50 lakh would be paid. The financial creditors decide how much would be paid to them and how much would be paid to the other creditors, and ordinarily they decide not more than 1 or 2%. Now, if you were to frame a scheme under the Companies Act, going for a scheme of compromise under section erstwhile 391 or now under section 232 to 234, no body of creditors would ever give you such an approval, because you require the scheme to be approved in a meeting of creditors having not less than majority in number with not less than 3/4 in value of the present and voting. Under IBC, you don't need to call anyone, and without asking them, whole debt can be written off. Not only that, you can decide, for example, I will write off liabilities before the appointed date, because Supreme Court has taken a view interpreting the scheme that when a new promoter takes over the company, he takes it with a clean slate, and therefore he cannot be called upon to pay any past liability unless the scheme specifically captures it. So I can provide in the scheme that rupees 500 crore payable to creditors would not be paid. I can also provide in the scheme that tax liability arising on account of write back would not have to be paid by me. But I can also provide that write-offs of asset will be done by me 6 months down the road, which means I will claim the benefit of losses because they are incurred by me, whereas I will not suffer on account of taxation because of write back of liabilities which I have projected a day prior to the appointed date. Therefore, you have a flexibility in framing of a scheme, and the ex-management is not only not required to be consulted. If ex-management has given money, let's say of 1,000 crore of rupees as loan, in any case they are not required to be heard for 1,000 crore. That you can always say, forget about it, you will not be paid. Therefore, when we look at the structuring of a deal, now that we have this IBC structure, I would believe between company law structure and IBC structure gives you far greater power, far more latitude, and also in a way, as I stated a little while ago, power, so to say, to make provisions in the scheme overriding other statutes. And therefore, when it comes to acquiring a financially weak company, one may consider whether to go for bilateral discussion by way of mergers or corporate takeover under the Companies Act, or whether to take that other entity before IBC, before NCLT under IBC, and have a scheme where you will have a clean slate approach, and you may be able to acquire the assets of the company without any corresponding liability, which will give you complete free hand once you take over the company.
Kaushik sir.
I think I have nothing more to add than what two stalwarts have said. So far as accounting is concerned, I think it is a follow-out once the scheme is structured. So that will be a subsequent decision. Only consideration I would say that so far as AS 14 is concerned, it provides two methods. It primarily deals with the pooling of interest method that has to be followed, and it has to be an amalgamation in the nature of merger, and which lays down 5 conditions. And it requires under the pooling of interest method, you have to carry the value of assets at the same value which was appearing in the books of the transferor company. But under the purchase method, the option is available to take the value of assets and liability at that fair value as on the date of amalgamation. But in that case, you will have to justify that you are not complying with the condition of amalgamation in the nature of merger. There are 5 conditions so far to define the amalgamation in the nature of merger. 90% of the shareholder should be the shareholders of the transferee company. All the assets and liabilities of the transferor company should go to the transferee company. The consideration has to be satisfied by way of issue of equity shares only. The transferee has the intention to carry on the business, etc. So what the planning can be made, or at the time of structuring, it can be made out in such a way that if you want to carry the value of assets at a higher value, fair value, then you should see that one of the condition is not satisfied so far as amalgamation in the nature of concern. Naturally, you will have an option to treat the accounting under the purchase method to enable you to carry value at a fair value per proposition. That's from my side.
Thank you, sir. Since you mentioned about the amalgamation, in the scheme of amalgamation, the date from which the scheme is applicable is mentioned. This date is the acquisition date or appointed date. What is the relevance and significance of appointed date in terms of structuring, implication under income tax, implication under Companies Act, as well as the impact on the accounting treatment, beginning with Ketan Bhai. And also, can the appointed date be traced back to more than 2 years?
Yeah, so I think, first of all, see, today we are in August 23, okay? The schemes which are being filed today are generally 1st April 23 or 1st April 24. So it can be antedated, normally it is antedated, but it can be prospective also. Now the MCA has also issued a circular to, Anjali, your last point. The MCA has issued a circular of 21st August 2019, that it cannot be antedated. I don't remember, but I don't think it can be antedated more than 2 years. Now, 12 months. It cannot be antedated more than 12 months. So that is becoming an issue. In one case, Saurabh bhai, in a family settlement, the one brother was running quote unquote a disputed division, and they are insistent that they will take the demerger date of 1st April 2019. I told them it is 4 years, returns have been filed, everything has been done, but they are insistent on doing this, and they are saying we will tell the NCLT. Now we have filed the scheme already, let us see, but they are saying that, because of these peculiar circumstances, we will ask the NCLT to have a forbearance on that circular, blah, blah, blah. I do not know what will happen, but as Saurabh bhai said, that is one. But to your other question, you see, in many cases, the appointed date is defined as the effective date. HDFC and HDFC Bank, for example. Because in such a mammoth merger, the regulatory nightmares of all that will become, impossible to handle unless that date is the effective date. But in most cases, I have seen, as I said in our example, April 23 or April 24 kind of thing. The one practical, there are several practical issues. One practical issue from a tax perspective, it may look like a small issue, is TDS credits and Form 26AS. That becomes a nightmare, particularly in mid-sized companies, which may not have the wherewithal to handle all this. So in such situations, unless there are very strong reasons, and we have filed a couple of schemes recently where we have said, let's do 1st April 24. Let's not, I am hopeful that today is August, but by that time, the scheme would have been, approved, let's say March 24, for example. So then you don't have that headache. But there are other issues of accounting, IT integration, all sorts of things which are, sort of beyond the domain of tax and regulations, which are also very critical. So a sort of post-dated date will normally give you a little more breathing space to plan. Accounting and IT integration is a nightmare. Complete nightmare. I'm not talking of a monolith like HDFC Bank, even in a 2, 3, 5,000 crore merger. Integrating IT systems, integrating culture. See, what happens is, in a merger, particularly of two unrelated entities, and sometimes even related entities, you have all sorts of HR issues. Okay? General manager here is called vice president there. Now, this is not a tax regulatory issue, but these are important issues to bear in mind. Kaushik bhai, these accounting issues, AS14 or Ind AS 103, it gives people time to plan. So all that. And of course, one case where the appointed date from a tax perspective is very important is if you want an investor and you want to show them the last balance sheet of, let's say, 23-24, then the choice is 1st April 23 because on 24, he sees a larger balance sheet. Or if you have losses in one entity in 23-24 and profits in other, then obviously you will want 1st April 23 so you can set off the loss. Of course, practical issues will arise in how will you pay advance tax. And the way we say it is that unless there are some reasons to believe that the merger may run into some objection, mostly it will not. So you don't pay advance tax on the basis that the merger has happened, although actually it may happen, may be approved later. So I think variety of issues, Anjali, on the appointed issue.
Saurabh sir, what are the implications under the Income Tax Act?
Normally, people prefer a backdate for the purpose of amalgamating because, let's say today I pick up 1st April 2023 as the appointed date. Once the scheme is sanctioned, the transferor company will lose its existence way back from 1st April 23. So if there are losses of the transferor company during this period, I can claim set off against the profit of the transferee company for the current year. This is ordinarily the reason as to why people prefer a backdate. It is for this reason people used to have backdates, not only 1 year, 2 years, 3 years, 4 years, so on and so forth. The circular to which Ketan has referred to says ordinarily they would not permit a retrospective date beyond 12 months. So it is not as if it's a legislation, it's advisory. So if you go for a scheme and give a appointed date which is more than 12 months before the date on which you filed the scheme proceedings, you need to give a justification. If there is a good justification, then obviously there will not be a problem. Now, what is good justification is something which is a matter which I am not addressing. There could be good, bad, or indifferent reason for the purpose of justifying good description, good justification. Number two, if I have appointed date from a back date, all inter-se transactions between the two companies will not be transactions between independent entities, they would be transactions within the department. And therefore, if there is a sale by one company to another, which was either taken as sale, may now be regarded as branch transfer. Under the old law, on account of a retrospective date of amalgamation, a petition was filed before Gujarat High Court, where Gujarat High Court accepted the contention of the SSE that transaction of purchase and sale between the entities will not be regarded as purchase and sale, and the amount of sales tax paid would have to be refunded. Not only that, Gujarat High Court also took a view that dividend declared by one company and paid to another company would be regarded as payment to self, and therefore there would be no dividend distribution tax, and dividend distribution tax paid would have to be refunded back to the dividend distributing company. Therefore, there are always pros and cons in going backwards versus not going backwards. It would not be one suit which will fit all. You will have to look at facts of each case. But I may indicate two things which are important. One, under the Erstwhile Companies Act, it was open to you to have your own creative accounting method for the purpose of accounting scheme of amalgamation or demerger, and people have used, or if I can use the word, grossly misused this loophole by passing accounting entries on a scheme of merger or demerger in an extremely creative manner, where revenue reserve is converted to capital reserve, where losses are converted to assets, losses are converted to goodwill, where losses have just disappeared from the books. I'm not going into greater detail. The legislature, having realized the possibility and as a matter of fact, actual misuse, now under the 2013 Act, accounting needs to be certified by the auditor of the company that accounting entries that you intend to pass pursuant to a scheme of amalgamation or demerger would be in accordance with accounting standard. So unless you take auditor on board first, who is prepared to give you certificate about the correctness of your accounting entry, that liberty will go away. Second, and probably more important, under the Erstwhile Companies Act, before approving the scheme, no notice was required to be issued, in particular to Income Tax Department, as a result of which, again, there are companies which employed creative tax schemes under a scheme of amalgamation. Once a High Court approved the scheme, they would present fait accompli to the Income Tax Department, and Income Tax Department was thereafter completely helpless in the matter of unraveling, because it can't go contrary to the High Court judgment. Now under the new Act, therefore, the notice to Income Tax Department is a must before a scheme is sanctioned, and of late Income Tax Department has become maybe extra vigilant. They see a ghost when there is none, and therefore many a times for no reason they raise objections, but there are times when they find objections there is serious objection against sanction of the scheme. NCLT does hear Income Tax Council, and if they find that objections merit acceptance, your scheme may not be approved, or sometimes what is being held is that all contentions of the department are kept open. They will deal with the same at the time of assessment. So, whereas there may be still a possibility of having some interesting tax saving, tax working in a scheme of restructuring under IBC, now you may not easily get away with the innovative tax accounting in a scheme which is a vanilla scheme under the Companies Act. This is how I would view the matter.
Kaushik sir, if you want to add.
Taking Saurabh's view on this auditor certificate, I think now it's a challenge that the company, NCLT now wants the auditor certificate regarding to the effect that the accounting treatment proposed in the scheme of amalgamation, merger or demerger is in accordance with the accounting standard followed by the company. The challenge may come, say in the past, some amalgamation which was approved by the court having a different treatment than what was in the accounting what is proposed in the accounting standard. And now that company is now proposing some other scheme of merger, and that accounting treatment is continued. The challenge will be for the auditor as to whether to certify that the accounting treatment which was already approved by the court and which was not in accordance with the accounting standard, how the auditor should deal with that situation. That may again be a challenge. Coming to the issue of appointed date, under section 232(6) of the Companies Act, the company has to specify a particular date as the date, appointed date from which the scheme will be becoming effective. There are two dates relevant. One is the appointed date, that is the date on which the scheme will become effective. Second date is the closing date, that is the date on which the order of the NCLT is received, and copy of the order is required to be filed with the Office of Registrar of Company within 30 days. And on the date of filing the copy of the order, the scheme will become operative, that is the closing date. So appointed date is the effective date, closing date is the operating date. The challenging for the auditor and the accountant is as to how to give effect to the scheme. That is whether he should consider the appointed date for the purpose of transaction or the effective, the closing date. Further, challenge is under business combination Ind AS 103. They have not used the word appointed date. Even under AS 14, they have not given any guidance about the giving accounting treatment of the scheme with reference to appointed date. Under Ind AS 103, they have used the word acquisition date. The question would come whether acquisition date can be construed as an appointed date or not. Because acquisition date they have defined as the date on which the acquirer obtains the control of the acquiree. That is the definition for the purpose of Ind AS 103. So to avoid the confusion, now MC has come out with a circular in August 2019, taking the base of decision of Marshall and Sons Limited Supreme Court decision, where they have clearly categorized at that time, under the old Companies Act 1956, that a company has to specify a particular date as the date of takeover, which should be considered as an appointed date. And from that date, the scheme can be considered to have come into effect. So for the purpose of our accounting, that should be the date. Taking that clue, the company law department has now clarified that for the purpose of Ind AS 103, the appointed date specified in the scheme should be considered as acquisition date, and that from considering that date, the accounting treatment should be given. Another challenge would become is the backdating of the scheme and its implication. Say in a particular scheme of amalgamation, the appointed date was January 2022. The order of the NCLT comes in March 23, and the copy of the order was filed on the same day. The situation would be that how to give effect to the scheme, the financial statements are required to be approved before May 23, being a listed entity. So in that case, the solution is easy. because the the order is received before the closing of the financial year. So company can give the effect of the amalgamation considering January 2022 as the appointed date. But in that case, they will have to recast the statement for the particular period from January 22 to March 22. It was, in our case, it was a case of amalgamation of the common control entity. So otherwise also, the Ind AS requires that in case of an entity under common control, the previous period financial statement are required to be restated, so the accounts were restated. But look at the other situation, that if the order would have been received, say after March 23, but before the approval of the financial statement, the question would come whether while finalizing the financial statement for March 23, the effect of the amalgamation should be considered or not. So in that case, under both the standard AS 14 and Ind AS 103, it is very categorically specified that when the scheme is approved after the balance sheet date, but before the approval of the financial statement by the board of directors, no accounting treatment should be given in the earlier period financial statement, but simply a disclosure will have to be made in the financial statement of particular year, treating it as an events occurring after the balance sheet date. So that is the importance of the appointed date so far as accounting is concerned.
Thank you, sir. We have last 15 minutes, so now the floor is open for questions from the audience.
So from income tax perspective, can we merge companies who are having opting for 115 BAB into, BAA companies into 115 BAB year on year? Because I think there is a restriction. So if you could, spread some light on that.
I don't believe there is a restriction. Let me check up. In the meantime, if you have an answer, because what you need to do is, you need to ensure that the transferee company, which is a continuing company, continues to fulfill the obligations put on it. If it does not comply with the condition, it will lose the benefit. There is no provision, unless I have missed out, which says that a company which is enjoying the benefit of a lower rate of tax is prohibited from merger or demerger. I don't really believe there is such a, but let me check up the act. I think taxman is outside. I'll check up and revert back to you.
Yeah, but just to add, Saurabh bhai, I'm just trying to think, we should look at the act, but if you merge a 25% company into a 35% company, then unless it changes, it will become a 35%.
Yes.
25 into?
17.
25 into 17%. So I think because, see, what will happen is the company which has chosen 17, the other company which merges, now that company is part of this company. So I would say the 17% rate would continue.
I'll just, in the meantime, yeah. I will get the act and revert back to you.
Saurabh bhai, this question is with regard to the Stamp Duty Act. In one of the case, as on the date of appointment, the circle rate was, means valuation, as far as the valuation is concerned, the immobile property value was the higher one. And the circle rate has changed between the date when the scheme was approved. So which should be considered for the stamp duty payment?
Okay. See, we must understand the rationale, and that will immediately give you answer. Under the Act, Companies Act, the order of the court or order of NCLT sanctioning the scheme itself acts as a conveyance. You don't need a separate conveyance. The conveyance is the court order. Supreme Court has therefore taken a view that it is this document of court order which requires to be duly stamped. Otherwise, the argument was very simple. Who pays stamp duty? Whoever executes the document. Who writes the order? Judge writes the order. Why should I pay stamp duty? Judge is not going to pay stamp duty. Why should anybody pay stamp duty? But that kind of childish argument did not appeal to Supreme Court. So court order is the conveyance. The moment you accept that, you will also have to accept that it is the date on which court passes the order is the date on which conveyance takes place. So if that is the date on which conveyance takes place, the property which is subject matter of conveyance on the date of the court order, the value thereof would be exigible to stamp duty. Therefore, you are raising one issue to which I will come to. Stamp authorities have in fact gone on a very weird situation. On appointed date, let's say I had 5 properties. But between appointed date and the effective date, where by the time scheme got sanctioned, let's say after 10 months, I have sold away 3 properties. So on the date on which the court sanctioned the scheme, I only had 2 properties. The companies argued that now that there are no 3 properties with me, why should I pay stamp duty? Stamp authorities still at times insist, because you are having appointed date and on that date there were 5 properties, you need to pay stamp duty on 5, which is an absurd argument, because take a converse situation. On that day I had no property, but on the effective date, I have 20 properties. Would they execute conveyance deed without charging stamp duty? Obviously answer is no. Therefore now I answer your question. You do not have to look at circle rate or jantri rate as on the date on which the appointed date is fixed. You look at the rate, market rate of the assets on the date on which court order is passed, whatever is the rate on which you will have to end up paying the stamp duty.
Okay.
But in Gujarat, the stamp duty is 1% of the value of immovable property situated in Gujarat, or 1% of the value of the shares issued in consideration, whichever is higher. So if value of immovable property is rupees 10 crore, it will be 10 lakh. But if the shares issued are worth rupees 15 crore, 15 lakh. If the shares issued are 8 crore, higher being 10 lakh. So that will have to be examined. But it will be the market value as on the date on which amalgamation order is passed.
Okay, thank you.
Company is having a subsidiary company, which is a private limited company. The company wants to transfer the equity shares to its holding company. So whether section 79 is applicable to that company, the private limited subsidiary company, whether business loss can be carried forward? The company is having a private limited
Subsidiaries allotting shares to holding.
and
No, ultimate parent, right?
Yeah, ultimate parent. A company is having a subsidiary, which is a private limited company. And A company now wants to transfer that shares to its holding company, A's holding company.
Section 79 uses the word beneficial interest. And if it's a wholly owned subsidiary, there are judgments which have taken a view that beneficial holder being the holding company, that section 79 restriction would not apply.
Yeah, I think absolutely. And you know, Saurabh, as you will remember, there are conflicting decisions. One is Yum Restaurant. I can't remember whether it says what Saurabh and I are saying or the converse, because there is a converse. But as Saurabh rightly
Yum is
said-
taking contrary view.
Sorry?
Yum is taking contrary view.
Correct,
Daily,
correct.
Daily. But I don't think that's a correct view, because the language
Correct.
is
So then
beneficial interest.
Correct. So Yum is maybe contrary, the other one may be. But I think the logical thing, see what, again, you have to go by purposive interpretation. And to my mind, logically, if the purpose is to deny the benefit of carry forward of loss where there is quote unquote a real economic transfer, here there is no economic transfer. So logically it should be available. Although of course in certain cases where it has been convenient, either the tax department or others have argued to the converse. But honestly, I think the more logical view is what Saurabh explained, and I agree absolutely.
No, I don't find any such prohibition under 155 BAB, so there should not be a problem.
Saurabh sir, my question is for you. It is specifically with respect to the allowability of tax depreciation on separately identifiable intangible assets which we value and then we recognize as a part of business combination under Ind AS 103. So I mean, are there practically challenges from tax, from getting this cleared from the tax authorities, like in terms of valuation, how those intangibles were valued, specifically like customer relationship kind of intangibles, which earlier, like most of values used to put entire thing into the goodwill. And now since they have clear demarcation, like, no tax depreciation will be allowed on the goodwill.
See, this is in a way self-created problem. I tell you why it's self-created. Delhi High Court in Areva TDS specifically taken a view, you will be entitled to depreciation. The problem arose because in case of amalgamation, whether or not on accounting entry of goodwill, you will be entitled to claim depreciation or not, Supreme Court, with great respect, in a patently erroneous judgment, took a view in case of Smiths that you will be entitled to depreciation. Prior to Smiths, people used to claim that on intangibles, I would be entitled to depreciation because under section 32(1)(2), on intangibles you were entitled to depreciation, but the word goodwill is not introduced.
Yes.
So to be on a safer side, people used to claim depreciation on bits and pieces and not on the composite value of goodwill. Once Supreme Court said on goodwill depreciation is admissible, everybody then jumped to goodwill. Now, by virtue of legislative amendment on goodwill, depreciation is not admissible. So now again people are breaking goodwill into components and saying ignore goodwill part. But look at the goodwill, it comprises of trademark, copyright, patents, customer interest, territory interest, blah, blah, blah. And therefore of the total consideration above the book value running into rupees 500 crore, goodwill is only rupees 20 crore, 480 crore comprises of these intangibles. And now revenue says, but look at Smiths, it says goodwill. So we are not going to grant you. Therefore, answering your question, yes, we are going to have challenge. But if you are able to justify two things. One, you had as a matter of fact so much of intangible assets. And two, on correct valuation, the value that you are claiming as cost is justified, I would believe you will still be entitled to claim depreciation irrespective of the fact that under the Act on goodwill depreciation is not admissible.
Because, sir, especially in today's era, for a lot of technology companies, for a lot of companies like Zomato, where, like customer base is a significant intangible component rather than any tangible asset. So I think this is critical because if challenges are raised from the valuation perspective, from the audit perspective, who have, signed off based the purchase price allocation report. So this could be a
I agree.
Majorly challenging issue. That's why I thought to clarify from practical perspective.
Like no, department would certainly raise an issue, but to my mind, if you satisfy these two conditions, A, existence of intangible,
correct,
and second, correct valuation of intangible, I would believe on that part you will still be entitled to claim depreciation.
Okay, noted. Thank you.
Just to add,
yeah,
in this customer relationship, take the case of an asset management company.
Correct.
When you take over that asset management company, you are taking because you have existing customers, okay, who are, let's say, subscribers to mutual fund units. So the reality of the situation is that in today's day and age, the intangible value is always going to be more.
Yes.
And you are paying for something.
Yes.
So therefore, so as Saurabh bhai says, while people have been splitting it up, I think in many cases there is a genuine reason. Now somebody can say, customer relationships may not be any other rights of a commercial nature. I mean, that argument can come.
Correct.
But subject to that kind of an argument, logically you should get it if the allocation is reasonable. And let's say in the case of, as you said, government contracts, the fact that you have a performance qualification, the fact that you have a track record is a major reason why you're buying the company in the first place.
Because, sir, when we draft this purchase price allocation reports, separately these are like cleared by the valuation teams from Big Four, who they're including the auditors. So obviously, the challenges will come, say, after 2-3 years from tax perspective. By that time, we would have depreciated almost major part of the asset.
I have a question for Kaushik Patel. Sir, see, in case of an amalgamation, under 103, you have to recognize all your assets, incoming all the assets if it is not under common control at fair value. Okay? So if there are intangibles, let's take this example forward. There are intangibles, they are recorded now in the books of the transferring company at fair value. Now when you look at the index, it says that the difference between the value recorded in the books and the tax value is a temporary difference. Now I am really not able to understand how can that be considered as a temporary difference, and thereby then there is a default tax liability which gets paid. Do you agree with this? Is it a temporary difference?
No, I think Dolphy has given in his book that this cannot be considered as a temporary difference, it's a permanent difference. And that is his view.
Okay, so then can you go ahead on that and say there is no dupatta liability creation required? Okay, that's a very good. Thank you very much.
Sir, I would like to know the challenges of carry forward losses with respect to IBC company when the resolution plan is approved by the NCLT. So is there any precedence where IBC we should look at? Is there any objection by the NCLT for considering the non-carry forward of losses even if there is section 79 which has already been provided in the Income Tax Act?
Section 79 by itself prohibits carry forward of losses if there is a change in shareholding by more than 50%. Proviso to Section 79 is now captured where if a scheme is approved by NCLT which provides for carry forward of losses, and if before the sanction of the scheme notice has gone to the Principal Commissioner of Income Tax and he has been given a reasonable opportunity of making his submission, then Section 79 prohibition would not apply. In other words, NCLT does not require approval of Income Tax Department in giving this relief to you. If NCLT is convinced that you want and you should be given the relief, NCLT has a right to override the objection also of Income Tax Department. So they are to be heard, not that whatever they say needs to be accepted. So once the scheme is sanctioned after notice to them and after giving them opportunity of hearing, you are bound by the terms of the scheme, including Income Tax Department. Under Section 31, subsection 2 of the IBC, once the scheme is approved, it binds all stakeholders, including government. So they would not be entitled to raise any objection. However, if NCLT while sanctioning the scheme, and it does sometimes say, we leave this to the discretion of the department, take it from me, they are always going to exercise discretion against the SSC. So one has to be extra careful while arguing and while insisting from the NCLT reliefs, concession, is a separate clause of reliefs in concession in every resolution plan, that this has to be granted rather than left to the discretion of the department. But once it is granted, I see no problem.
One last question.
Hello. Yeah, my question is, we have actually merged two group companies. One company, transferee company, is in existence for more than 5 years, but commercial operation are less than 2 years. Can we get the benefit of 72 tax losses, unabsorbed depreciation losses?
Sorry.
Transferee company incorporated 5 years back, but commercial operation started less than 2 years. So can we get the benefit of unabsorbed depreciation in the transferor company?
Depreciation.
Unabsorbed depreciation losses.
No. Depreciation or loss?
Unabsorbed depreciation loss.
Unabsorbed depreciation.
Yes.
But under which law you will claim unabsorbed depreciation except under Section 72A?
Yes.
Under 72A, there are conditions for the purpose of getting the losses and depreciation of transferor into transferee. If you satisfy those conditions, you will get the benefit. Now your question is, but I per se would not satisfy a condition because I am not born 5 years before. And
No.
one of the condition is,
Incorporated 5 years back, but commercial operation is less than 2 years.
of the transferor or transferee?
Transferee company.
Transferee.
Yes.
How is transfer is birth important? Transferors.
I think what you mean is...
Sorry, transfer, sorry. Transfer.
Then you do not satisfy the condition.
Yes.
If you do not satisfy condition, you will not get it, because this is, so to say, an exemption or a privilege. It's well settled. Supreme Court has taken a view that in order to claim the benefit of an exemption or a privilege, the law will have to be interpreted strictly, and you cannot take two views. It's a different matter of interpretation of penalty provision, like with vegetable product. But when you're looking at exemption provision, it will have to be construed strictly. Section requires 5 years existence, 5 years commercial operation. If you can't satisfy, you can't satisfy.
I think, Saurabh bhai, if I remember, I don't have that section in front of me, the relevant, but I think it is talking of business being carried on for 3 years.
Yes.
It does not talk of existence.
Yes.
Number one. So therefore, to my mind, Saurabh bhai, there may be an argument possible, strong argument possible, that if my commercial production started 2 years back, it should be. Because you see, I'll tell you why. The other reason. In the context of the commencement of quote unquote previous year under section 3, it starts from the date on which quote unquote the business is set up.
Right.
The date of the business being set up in the classic case of Western India Vegetable Products, which is now called Wipro, I think 21 ITR Justice Chagla's decision, 26 ITR 151. I think the date of setup, to my mind, can be argued to be the date which would be relevant and not the date of my birth. Saurabh bhai, I would defer to your judgment.
No, I'm not. I'm saying, please look at the language. Amalgamating company has been engaged in the business in which accumulated loss occurred or depreciation remains unabsorbed for 3 or more years. Can you say you are engaged in the business? If answer is yes, you have no problem. If answer is no, you have a problem.
The has been engaged in the business. I agree.
That is
because it talks about
engagement in the business.
Except that you read in the clause to say, assuming I have been in existence for 3 years, so somebody like Mr. Saurabh Soparkar can possibly argue it favorably.
We can argue anything and everything, question.
Thank you, sir.
Thank you. Tax, compliance, accounting and auditing aspects, all the aspects covered during this panel discussion. We are thankful to the panelists for their valuable inputs. Also, we are thankful to the participants for raising the proper query, learned participants, and though the time was short for the panelists, then also they tried to cover as much as they can. Sir, thanks a lot for giving your time and clearing the doubts as well in the session. And we again will seek your platform or again at the Ahmedabad branch in near future, sir. Thank you. Thanks a lot, sir. Thank you.